Welcome to the weekly meeting, everyone. My name is Zor Morales, and I graduated from the program about 2 years ago. So not too long ago, I was in your position. So I help out with running these weekly meetings and talking about real estate topics and test prep and transitioning from the military into the real estate profession. Today, we have part 2 of our tax fundamentals class from Nicholas Warnoff. So I'm going to go ahead and pass it over to him and stay tuned for some spectacular information.
Yeah, awesome. Thanks. I'm going to try and fly through this. This week, it's going to be really dense again. Me and Zor both agreed. If you are operating any heavy machinery right now, please stop, because this presentation, it's all about tax strategy. We don't want you falling asleep driving or anything like that. So with that, Zor, can I get the ability to share my screen? Do I have it?
You should be good.
There we go. Yeah. 3, 2. And there we go. Is everybody seeing a real estate tax fundamental concepts and strategies? All right, cool. I'm just going to blow through real fast what we went over last week as a really quick just kind of recap, so it's fresh on your mind going into these strategies. All right. First off, most important slide, the disclaimer. I am not a CPA. I am not a tax lawyer. Okay. It is on you to go talk with a local licensed professional in these areas before employing these concepts. Okay. Though federal laws are nationwide, state, county, city laws will vary based on your location. Also very important. Just because I say it's here and it applies to me in California, that doesn't mean it'll apply to you in whatever state you're in right now. All right. So again, cannot overemphasize the importance of talking with a CPA or a tax lawyer when it comes to implementing these strategies. All right. Next, don't put the cart before the horse. Okay. You have to make money to be able to save money. All right. So don't go out and spend $5,000 on a CPA when you're only your taxable income's not as high as that. So yeah, very important. Key terms and concepts. All right. Tax evasion versus tax avoidance. We want to stick with tax avoidance. Okay. Burden of proof. It's on you. All right. You are guilty until proven innocent if you are audited. All right. So keep your receipts. Why does it matter to you? Keep more of your own money. Hopefully the most important reason. Help your clients keep more of their money, and work with tax savvy investors who want to keep their money, but work with real estate agents who know how to do that. All right. Types of taxes. Income tax. That's the big dog. We're going to spend a lot of time on that. Capital gains tax. Another huge one that you're going to want to avoid. Levels of taxes. Federal government, state government, county, and city. We're going to talk about how to avoid all of those, except city. I don't think we talked about city. Most cities don't collect income tax. So most taxed state, lovely California. Real estate professional. We talked about the criteria of being a real estate professional. You have to spend over 50% of your working time and at least 750 hours per year. This week, we're going to talk about the benefits of being a real estate professional and how you can leverage that. All right, gross income. That's all the money you made. Adjusted gross income, that's all the money you made minus adjustments. Taxable income, that is the adjusted gross income minus deductions. Okay, so there's that formula. And here's the sheet that we report that on at the end of the year. All right, ways of reporting it. We have our W-2, W-4, 1099. That's what real estate agents report their income on. And Form 1040. That's what you file at the end of the year. All right, adjustments. Again, that is a deduction that you get off the gross income. Okay. Exemptions, those are not going to be in effect until 2025. So we're not going to worry too much about those. Again, deductions, tax bracket. We're going to go how to put yourself and your family in the most favorable tax brackets. In other words, the lowest tax brackets. All right. And the progressive system. We went over what that is in detail. Here's that tax bracket. We're going to see that again later. Tax credits. Remember, a tax credit is a direct reduction of how much taxes you owe. So it's not a reduction of your taxable income. it directly reduces your bottom line. So these are some of the most powerful, and we're going to go over some later. Just remember the examples though. Rehabilitation energy or renewable energy tax credits. There's a lot of incentives out there to use energy, renewable energy programs like solar panels, electric vehicles, etc. Work opportunity tax credits, hiring what the government feels is disadvantaged groups like veterans, for example, low income housing tax credit, providing housing for low income families can also literally adjust your bottom line of taxes. Okay. Self-employment tax, we're all going to pay this, but there are ways of reducing this that we're going to go to later. All right, statutory non-employees, again, that's all of us. We're a real estate agent. Calendar versus fiscal year. We touched on that last week. We're going to go into more detail this week. And a loss, that is pretty self-explanatory. But we're going to go over how being a real estate professional increases how much you can claim on losses. All right, active versus passive income. Remember, passive income is actually taxed less than active income. And as a real estate professional, there's no cap on how much passive income you can make. Okay. Tax liability. That's all the taxes added up. Okay. So your city, state, local, and federal taxes all combined. Don't be like this guy. Keep those taxes managed. All right. Tax deferment. That is avoiding paying taxes this year to pay at a later date, though hopefully we just keep pushing that later date back forever. All right. And that brings us to this week's presentation, best tax strategies for real estate professionals. Okay. So we're going to build on the key concepts that we went over last week and just touched on. This is to expose you to all of those strategies so you can employ them. But the specifics are on you and your CPA. Okay. We're going to broadly touch on these. All right. Not go into specifics because they're going to vary state by state and they might not be applicable to you and your situation. So please, again, I can't overemphasize, this is not a comprehensive guide. Talk to your CPA. All right. There's still 6 weeks left in 2023. So that gives you time to employ some of these strategies. But many of the deductions you can legally backdate. Okay, so if you don't quite make the cut December 31st on some of these deductions, talk to your CPA. You might be able to backdate them. Okay, if not, you'll just have to claim them next year. All right. I'd recommend talking with a CPA before the end of the year, really as soon as possible, coming up with a plan to minimize your tax burden. All right. And then filing next year as soon as possible so you can get that money back as soon as possible. Okay. Next. All right. Meet the untaxables. All right. This is the untaxable family. They're first generation American family. There are a couple here to realize the American dream through real estate. And we're going to make sure they don't pay anything in taxes. All right. They're going to be our example going through all these. All right. Mr. Untaxable is a real estate agent and Mrs. Untaxable is a stay-at-home mom. Baby Untaxable here with the laser eyes is currently unemployed. What a piece of garbage. All right. Because he's a good business owner, all right, Mr. Untaxable filed quarterly earnings. And in his reports, he paid $66,000 throughout the year based on his expected earnings. Okay. That number, I got it by going to keeper.com. All right. And they have a 1099 income tax estimator. Okay. That will help you calculate how much you should be paying in taxes quarterly based on the amount of income you expect to earn at the end of the year. That $66,000 I got from an estimated income of $200,000. Okay, so we're going to talk about how Mr. Untaxable is going to reduce that to nothing. All right. Yeah, so there are earnings calculators. Like I said, I used Keeper for this one. There are many others. The IRS even has their own on their website, but those are for W-2 employees. I don't think they have one for a 1099, or at least I wasn't able to find one. All right, there's penalties for not paying quarterly as well as underpaying. All right, and there's about a 10% buffer if you don't guess right, which I think is a little ridiculous, but we won't talk about that. However, the IRS tends to be lenient on businesses in their first year of operation because most businesses don't make any money in their first year anyway. So if it is your first year of operation in a business and you didn't file quarterly earnings, you're probably in the clear. Okay. With that covered, let's see how the untaxable family avoids paying their taxes. Step 1 is to incorporate. All right. Create an LLC, S Corp, C Corp, or sole proprietorship. These laws differ slightly state to state, so verify the local laws around your business and entities. Research the different entities and consult with a CPA or tax lawyer to see which entity is best for you. Each entity costs money to create, okay? So until you're making money, the best option could be none at all, okay? Again, don't put the cart before the horse. If you're not making money, don't try and save money, all right? Step 1 is for Mr. Untaxable to incorporate because it provides so many advantages. All right, most CPAs and tax attorneys agree for real estate agents starting out, S Corps, LLCs filing as S Corps, or sole proprietorships are the best options, okay? He can control how much he pays himself, so long as it's a reasonable salary, thus minimizing the self-employment taxes for a large chunk of his income, okay? So he essentially splits his income at that point. He can draw income by paying himself, okay, as a W-2, all right, as a salaried employee, and that will he will pay income taxes on that, so Social Security and FICA, right? But he also takes profits from the business itself, okay, and that he doesn't have to pay self-employment taxes on because he's a business owner, right? He just gets the profits just like you would from a stock, okay? He also gains the ability, he will still pay some taxes on business profits, by the way. There is still taxes on that, but he won't be paying the self-employment taxes on that, okay? All right, he also gains the ability to write off many more expenses as deductions and can hire his family as employees or rent out his home to his business, which we'll get into later, all right? That's called the Augusta Rule, and it is very much worth a Google. All right, here's a chart that explains things quick and dirty. It shows the tax and legal benefits of each type of entity, okay? Important things to notice here, S Corps, sole proprietorships are pass-through entities, and they allow the money you make to be taxed only at the employee level, okay? So the business itself is not taxed, all right? You're only taxed the money that you take in profits, all right, and the money you pay the employee, which could be you, all right. The S Corps are taxed at the corporate level and employee levels, okay, or excuse me, C Corps are taxed at the corporate level and employee levels, okay, and that's why most CPAs agree that it's not worth it for a real estate agent to have a C Corp, excuse me, because you'll be taxed at both the corporate level and the employee level. So you'll be taxed twice to pay yourself. So that most people agree C Corps aren't the way to go if you're a real estate agent. Okay. All right. As an LLC, in the state of California, and I believe most other states, you can choose how you want to be taxed. You can file as an S Corp or a C Corp. So LLCs give you that advantage, but it just makes more sense in most cases to go with the S Corp. Okay. One thing to remember, setting up these entities costs money, okay, including legal fees and taxes. So for more casual real estate agent, for example, just a referrals agent, like if you happen to have your real estate agent, you invest on the side, and you also give referrals to other agents, but you're not going to showings, you're not doing open houses, anything like that, a sole proprietorship might be your best option because the cost is the least to set up, okay? It doesn't offer any legal protection, but if you're not actively representing clients, then you don't really need legal protection, all right, to be that real estate agent, okay? Next, let's look at deductions, all right? Step 2, minimize income tax through deductions, all right? Track all your expenses. This is hugely important. I have 3 separate bank accounts now. Yeah, one for my business, one for personal but business expenses, and one for personal expenses. Okay, this allows me to use different cards for different expenses. And then at the end of the year, I can just go look in my bank account and it very quickly summarizes all of my business expenses. That makes it so much easier to create an itemized report for me to give my CPA, and then my CPA goes through it And he says, yep, this is an expense. We can deduct this, yada, yada, yada. So that's a huge pro tip that if you're not already doing, I really encourage you to do, is get multiple bank accounts. If you're banking with Navy Federal, it's, I think, at no cost or like $5 a year. So very much worth that convenience. All right, some examples of very common deductions for real estate agents: mileage and vehicle expenses. There's apps that'll help you track this. Home office deductions, office expenses, marketing and advertising, professional fees, and it keeps going on, right? This is what most people talk about because there's just the most meat on the bone here. If you track all of your expenses by the end of the year, you're probably going to be able to write off most everything. There's tons of other material and literature out there, YouTube videos, TikTok videos, even apps like Keeper that'll do all of this for you, or the videos will tell you how to do it, but there's even apps that'll almost do it for you. There's infinite routes you can go. People get just extremely creative with it. Like I said last week, I wrote off a wingsuit, and I'm not the only person to do that. I didn't come up with it. Some write-offs will seem absurd, like the wingsuit. Others will seem completely sensible, though, but they won't actually be deductible. And an example of that would be a business suit, right? It seems absurd to me that a wingsuit you can write off as a tax deduction, but a business suit you actually can't. Okay, and the IRS's argument for that is, well, you can wear a business suit for personal activities like going to weddings and funerals. Okay, sure. So you can go spend $1,000 on a suit that you might only wear for business presentations, and it's not an expense. So yeah, definitely verify all of this. You might think it makes sense to be a deduction, but there's a 1% chance it's not. Okay. Like I said, the best way to tackle this is to create an itemized list of your expenses. Okay, keep all your receipts, and then go talk with a CPA who can actually crunch the numbers for you and figure out what you owe. Okay, remember, Google is your friend here. Okay, however, you need to verify everything that Google says. Verify everything that I say, please. If you see something wrong in this presentation, DM me and let me know so I'm not on the wrong path. Okay, but the CPA is going to be the lowest authority, and the ultimate authority is, of course, the IRS. They're the ones who actually make that decision. All right. So more examples of deductions. Education and training. If you're paying to go to classes for real estate, guess what? You can write that off. All right. Real estate taxes and mortgage interest. Yeah, your mortgage interest, you can write it off. Insurance. You're going to be paying a lot of your own health insurance and things because you're a because you're self-employed, you're a 1099 employee. You can write off all of that. All right. Travel expenses, we already talked about. Entertainment and gifts, equipment, software and subscriptions. Your client or leads manager, you can write off. Telecommunications, your phone bill. All right, legal and professional services, setting up your LLC or S Corp, retirement, self-employment, business meals, bad debts, the list goes on. I mean, there are so many things that you can deduct. So like I said, the best strategy, keep track of all your business expenses, keep your receipts, and then go talk to a licensed professional who can actually do this for you. Okay, and verify that it's all legit. All right, hopefully you're getting the idea here. So let's see how Mr. Untaxable really used this method in an amazing way. All right, Mr. Untaxable's new truck. All right, Mr. Untaxable needs to buy a new vehicle for his business. He just needs to get around town, right? He researches Section 179 vehicle deductions, which I highly encourage you to do as well, and learns that if he purchases a vehicle weighing over 6,000 pounds, he can deduct 100% of its MSRP. Okay, notice that is not what he paid for it. That is its MSRP. So he could have paid more, he could have paid less. All right, that's going to depend on a lot of things. Okay, he also researches EV tax credits and learns he can receive tax credits lowering his federal and state income taxes directly if he purchases an electric vehicle. Okay, this could be huge, especially depending on what state you're in. Right, he thus decides to purchase a Ford F-150 Lightning because it meets the criteria for all credits and deductions. All right, I do drive a Ford. All right, I love it. But the reason that I chose the F-150 Lightning is because it's an obvious qualifier for both the 179 deduction and the EV tax credits. Okay, but there's plenty of other vehicles that also qualify for both. All right. Just go Google it. Tesla makes like a Model X or something that qualifies for the Section 179 vehicle deduction. There's other SUVs out there that do. Most SUVs and trucks qualify for that. Okay. For some states too, such as California, they also offer their own tax credits for electric vehicles. And I believe California's actually matches the federal one, which is incredible. That means you could get $15,000 in tax credits for buying an electric vehicle. That is awesome. On top of that, he also, you talk about the tax credits. So just by buying this truck, all right, he has reduced his taxable income $54,000. And then on top of that, gotten $75,000 in tax credits on both his state and federal taxes. That is an incredible amount of savings right there. All right. We're going to look at the tax bracket later, and you'll see just how powerful that is. He probably moved 2 brackets with that purchase. All right. Next, depreciation. This is normally the most powerful tool in a real estate investor's tool belt. Okay. So we're going to dive pretty deep into this. This is the loss that we incur due to deterioration of the property over time. Okay. Notice here, it's a paper loss. Okay. The building itself might be deteriorating, but the land is actually going to be going up in value most of the time. Okay. There are certainly parts of the country where like factories close down, there's job losses, etc., where the value of the land decreases. But for the most part, land value increases over time, and that more than makes up for the depreciation of whatever homes or businesses are on top of it. Okay. So, all right. Talking about, here's the definition here. We went over it last week. All right. And useful life. Okay. So useful life is considered 27 and a half years for a residential home. Okay. And this is what we use in straight line depreciation. All right. However, you can also do what's called a cost segregation study that itemizes each of the components of the house and shortens their useful life based on that particular component. Okay. For example, a roof normally only lasts about 7 years. Okay. Thus, they depreciate much faster. All right. So you divide the total cost instead of over 27 and a half years only by 7. And that allows you to deduct much higher amounts on your taxes. Okay. To do this, you need to hire a cost segregation professional. Okay. This is most likely going to be an engineer, and he'll perform a cost segregation study on your property, putting a number value on how much of the house's value has actually decreased based on each individual component. This is typically drastically higher than straight line depreciation. Okay. You can also claim bonus depreciation in the first year of owning a component of a property. Basically, you can claim 100% of that component's value in the first year of owning it. Okay. For example, if you get a new roof, you can opt to write 100% of that depreciation off in the first year, or spread it out over its useful life. This gets much more complicated. So before implementing this strategy, again, talk with a CPA, talk with a cost segregation specialist. Okay. And know that if you sell, this is technically deferring the tax. Okay. If you sell the property before the end of its useful life and you've been using this technique, you'll need to pay back all the taxes you claimed from the bonus depreciation. And that's where it gets messy. And that's where you really, really need to go talk with a cost segregation specialist or CPA. This is one of the best ways to leverage being a real estate professional, such as ourselves. All right. If you remember from last week, to be a real estate professional in the eyes of their IRS, you must materially participate in real estate over half your working hours and for greater than 750 hours per year. If you're a full-time real estate agent, you're going to do way more than that. Or if you say work a W-2 job like being in the military and your spouse can qualify as a real estate professional and you file jointly, you can both use being a real estate professional or the advantages of being a real estate professional. That's another way of doing it. But anyway, as a normal, so the amount that you can claim in depreciation as a non-real estate professional is limited. Okay. And I don't want to go into the specifics. We could talk about that for hours, but there is a limit on how much you can do. Once you are a real estate professional, though, that limit pretty much goes out the window. Okay. And you can claim passive losses up to however much you lose for however many properties you have. And it's just going to go against your passive income. All right. Which we talked about earlier. So you can claim pretty much unlimited passive losses or unlimited depreciation as a real estate professional. And that is one of the biggest advantages of being a real estate professional. And it's why you see all these real estate tycoons never paying anything in taxes. Okay. Because the amount that their properties depreciate offsets the amount that they actually gain in passive income. All right. So write that down. If you're not a real estate investor, go out and buy a house that you can rent out just so you can use these strategies. Okay. And another quick tip, if you own a short-term rental, you don't have to meet the real estate professional criteria we talked about earlier. Okay. The short-term rental pretty much automatically qualifies you, but Google the specifics on that. And again, talk to your CPA. But short-term rentals make it much, much easier to qualify as a real estate professional, and that comes with huge benefits. All right. Step 3, spread the income. Spread out income over as many entities as possible to minimize your tax brackets. Okay. If you own a business, plan how much to pay yourself in order to keep your income at the lowest bracket possible. If you're married with a business, pay your spouse in order to keep your business income low and keep your own income low. And if you own multiple businesses, spread that income out so your businesses are also in the lowest tax brackets. Okay. And here's a pro tip: hire your kids for administrative tasks, such as cleaning and other jobs anyone of their age could perform, arguably. Remember, the burden of proof is on you. So if you're claiming your 10-year-old is like filing your taxes, for example, and you're paying them for it, the IRS probably isn't going to buy it. But if you're paying your 10-year-old to clean the office space in your home office, well, that's a little bit more believable. All right. So how does Mr. Untaxable employ this method? First, he marries Mrs. Untaxable. Okay. That's huge. All right. I know it's like obvious, like, duh, they're married. But I just want to emphasize how big a tax break you get from filing jointly versus filing single. Okay. You according to Keeper's income tax estimator, filing jointly versus filing single reduces Mr. Untaxable's income tax from $66,000 to $54,000. In other words, it reduces his taxable income $12,000 a year just by claiming to be married. Okay. Next, he hires his wife, but he only pays he and his wife reasonable salaries of $50,000 each. Okay. This decreases their taxable income to $22,000, which is $44,000 less than the original. Okay. That is, yeah, that is massive. All right. Lastly, Mr. Untaxable hires baby Untaxable for modeling and advertising. Okay. Because even a baby can be a model, right? Paying him an annual salary of $10,000. Okay. Again, burden of proof, it's on Mr. Untaxable. But if he gets audited and he can produce photos of little baby Untaxable modeling in front of their home, well, the baby's a model and the baby received $10,000 in a salary for being that model. Okay. So with just this strategy alone, all right, Mr. Untaxable was able to save $45,000. Okay. That is huge. All right. Next, defer taxes forever. Here's the top 3 strategies. All right. Use a 1031 exchange to defer property taxes when selling. Offload properties through seller financing versus just a total sale. All right. And invest in traditional IRAs, then self-direct those IRAs to purchase real estate investment properties. All right. Here's some of the methods you can use. There are many more ways of deferring taxes, but I think these are the big 3 for real estate professionals. All right. Starting with the 1031 exchange, because it's probably the most powerful for you and your clients if your clients are real estate professionals. Okay. So let's see. We'll go over the specifics of that on the next slide. All right. Offloading properties through seller financing versus total sale is the same principle as tax bracketing that we went through earlier. However, instead of spreading out the burden over multiple entities in the same year, all right, you're spreading the income over the same entity over multiple years. Okay. So you're, again, just moving that income up in the bracket. All right. So you're paying less taxes on it. And also it makes it much easier to write off that money or that income by deductions, right? It's easier to find 10,000 worth of deductions a year versus $100,000 of deductions in 1 year. Okay. So seller financing can be a really tax advantage way of selling a home. All right. Investing in traditional IRAs, then self-direct them to purchase real estate investment properties. Again, look up the specifics on that. All right. This one's brilliant. Not only is it a method you can use, it's ones that your clients can use. If you have a client who wants to purchase real estate, but they maybe don't have the funds or don't think they have the funds, but if they have a really strong IRA, excuse me, they probably do. They just don't know how to use it. All right. And it's a method you can use to find partners to purchase investment properties, because if they have really strong IRAs, they can direct that capital into a property if maybe you're lacking in capital, and they can do it without paying taxes, which I don't know if you've ever invested in stocks, but stocks get taxed pretty heavily. So investing in real estate is probably going to provide them with much better tax advantages. All right, let's get to the 1031 exchange. I'm going to fly through this as quickly as I can. All right. This is also known as a like-kind exchange, the tax-deferred strategy used by real estate investors. Here's the rules. All right. Must be an investment property, cannot be a primary residence. All right. Must be a like-kind property. In other words, if it's a single family residence, you can't go buy a commercial property. All right. It has to go from one to the other. All right. Has to meet the timeline. All right. You have to identify the property within 45 days, and you have to close on the next property in 180 days. And you have to use a qualified intermediary. The money from the sale of the first property goes to the qualified intermediary, and then the qualified intermediary sends the money to the seller of the next property. Okay, so very important. If you don't use a qualified intermediary, it's not a 1031 exchange, right? And the new property must be of equal or greater value. You can't sell $1 million home and then buy a $10,000 home and not pay taxes on the difference. No, the IRS isn't that dumb. All right. I think we just went over all the key points here, so I'm just going to skip that because we're out of time. All right, here's how the untaxables did it. All right, the untaxables rental home. Mr. Untaxable owns a rental home worth $100,000 that he can't refinance due to construction code violations. So it's probably this one here in the top left. All right, he sells the first home with the proceeds going to a qualified intermediary, then identifies a new like property, this one, within 45 days, and he closes within 180 days. The new property is $110,000. All right, and because Mr. Untaxable met all the requirements, he paid no taxes. Okay, and we're going to go over later why that is such a great strategy. All right, house flippers use this strategy to create the snowball effect. All right, so they go from one house to the next, to the next, to the next without paying taxes on any of them. All right, so you might be wondering, how does Mr. Untaxable do this 1031 exchange and then get at the equity in the home, though? Okay, that brings us to our next strategy. Debt is untaxed. All right. So when you refinance a property, the money you are loaned is untaxed, as well as the interest payments on the mortgage. All right. So you read that correctly. All right. Hopefully you're making the connection. Mr. Untaxable, instead of selling his home, all right, refinanced it. And he was able to maintain control of the property, continue gaining income from it. All right. And he was able to get the equity out of it. Yeah, he was able to make, let's say, $80,000 or 80% of a $100,000 home. He was able to put that capital back in his pocket to be reinvested in a different property. Okay. And it's totally tax-free versus if he had sold the property, he would have paid massive taxes on it. Okay. And he wouldn't have the property anymore. He wouldn't be getting that appreciation or cash flow from it. Okay, so moving on to the next one. This is debt is untaxed part 2. This works for Mr. Untaxable's truck also. Okay, so when he bought that truck, he only put $12,000 down, or 20%. Okay, but he got the tax benefit of the total value. All right, so he spent $12,000 to get a $54,000 deduction, thus getting $42,000 in untaxed income and a new truck, in addition to the tax credits for being an electric vehicle. That is huge. Okay. If you looked at the tax bracket earlier, $12,000 is enough to move you into another tax bracket. That is, or excuse me, the $42,000 is easily enough to get you into another tax bracket. And he gets an awesome truck. Okay. Primary residence tax exemption. If you've ever lived in a property for at least 2 of the last 5 years, all right, you can sell that property tax free. Okay. This is what I did 2 years ago when I made more money in one transaction than my entire naval career. I didn't pay a dime of taxes on that. Okay. The limit for a single filer is $250,000. A joint filer, so for someone who's married, $500,000 for a married couple. Okay, this is really powerful for flippers too, because you can use that 1031 exchange method to purchase a home and then live in that home for 2 years and then sell that tax free. You don't pay taxes on either property sale at that point. And that's how you can defer taxes indefinitely. Okay. Next, avoid paying state income tax. Establish domicile in a tax-free state. We talked about those earlier: Florida, Texas, Nevada. Research local tax credits and the state benefits for veterans. Google these. These are your friend. California has huge state benefits for veterans. And I live in the most tax-unfriendly state in the nation, and even they have them. So please look into that on your own. Establishing domicile in a state can be a tricky one if you're a civilian, but if you're in the military, if you get stationed in Florida, Texas, Nevada, any of those states we talked about last week, okay, you can apply for residency in that state. And it's especially easy if you just bought a house there. Okay, so you can really leverage that for the rest of your career. All right. But even if you live in Florida, if you make money in another state, you have to pay income tax for that second state. So if you live in Florida, sell a house in California, you're going to pay income taxes for California. Okay. Yep. And moving on. Avoid paying county property taxes. This is one of the hardest ones to avoid. California has benefits for veterans in this area, but most places don't. Okay. But there's a huge thing. There's a caveat to this, why I'm still mentioning it. Okay. When you or your clients purchase a home, be aware of how the local taxes are collected and how your escrow or mortgage handler will collect and pay those taxes. In most areas and mortgages, the mortgage handler will collect money monthly and pay the taxes for the owner. However, the county tax collector will still send a bill to the house. Okay. So your escrow, your mortgage handler, they're going to pay your taxes. All right. But the tax collector still sends the bill to you. Okay. So don't pay that bill if your mortgage handler is already doing that. I'm saying that because I've seen it happen. All right. People get a bill. They say, oh my God, they pay it. It's already been paid or it's going to be paid. Okay. So special note there. Also, some states, California included, all right, you get an additional tax when you buy a home, and it's called the supplemental taxes, and it can hit you pretty hard if you bought the house and it appreciated substantially from the last seller. So, excuse me, that's a big one. Tell your clients to budget for that and expect it, and research the local tax laws in your area so you can help clients with that. All right, calendar versus fiscal year. We went over the benefits of that last time. Questions? Sorry, I went over big time on that. I was trying to bust through it as quickly as possible, but yeah. Any questions? Any comments? I know we went through that very quickly. Do we have any time for questions, or do we just need to pull tracks?
We have time.
Okay, cool. Yeah. Yeah, if
Roger
anyone wants to raise their hand.
Yeah.
Oh, Roger, what do you're already you probably know more about this than I do. What's your question?
So I don't have questions. I have comments.
Oh, okay.
No
Thank
questions for you, Nick. Sorry. So those of you that don't know me, I'm Roger. I have an MBA and a concentration in taxation. So this is my area. I love this stuff. There's so many things about it. So as somebody who has owned an LLC, both single and partner, and now I own an S corp. S corp is the way to go. Just be careful when you come up with LLCs. Okay, so if you don't claim S or C corp and you just stick with an LLC, be careful with it, because everybody's like, oh, I have all these protections and it's so awesome, and you don't. It's you do have protections, but it's known as, through the IRS tax code, as a disregarded entity. So you can do it, you can have it, you have the protection, like if you put your house in your car, that's awesome. But you don't get all the awesome tax benefits. Like an S Corp, if I remember correctly, you're taxed at like 8.7% of total income through the business. Like you don't get those tax breaks with that. So, but it's somewhere to start. So if you're looking to start somewhere and you want to fill out how the business realm goes, that's the way you do it. You start out as an LLC, you get to play with it a little bit, and there's a 10% buffer, like Nick was saying. So it's awesome. If you do establish a business, whether it's an S or C Corp, go through Delaware. Go look at Delaware's tax benefits and everything. I have 3 businesses that are out of the LLC, the S Corp, and the C Corp. They have all gone through Delaware. I've never stepped foot in Delaware. I've never been there. I probably not putting it on a map, but it has the best tax breaks for the state tax breaks. I think I paid $7 in tax stuff. Okay, so
awesome.
There's that. So Nick was talking about writing off clothes. Okay, if you do it the right way in the miscellaneous section of your business, okay, you can, if all of your suits and stuff are 2% of your total income, and it accounts for 2%, you can write off it's called a uniform allowance. You can write that off, but it has to be 2% of total income. So if you made $600,000, good luck with that. It's not happening. I mean, I guess you could, but it'd be a waste. And then employing family members. If they're under 18, you can employ them for up to $13,500 per child. Okay, so whether you actually give them that money or not, that's on you. I wouldn't. I'd throw it in like a college savings account or something like that. And then the cool part about businesses, though, if you own a business, whether like mine's a taxi business, it makes a decent amount of money. It's awesome. Business loss, quote unquote, transfers to personal. So if your business loss is negative 50K, you can but you owe 50K, you can transfer that loss to your personal. Do this through a CPA. Don't try to do it by yourself. I tried to. I ended up owing money. It was terrible. But you can file a form. I believe it's called 1199 EZ, and you can transfer your business loss to your personal loss, and you can break even. But you can't go negative and get a tax refund, because with personal, that's how you get a tax refund. You pay the government too much. You have to break even, and then you'll never see the rest of that money. But you break even, so that's cool. And then the last one I had was a business investment account. Okay, so if you go look into your business investment accounts, if you own a business and the business as a separate entity owns an account. So my business is called Paxar LLC. Well, actually, it's an S Corp now, but Paxar owns a business investment account. Okay, I can write off 11% of what the account earns. So as long as my account doesn't earn more than 11% interest, I owe nothing. It's called backdooring. It's like a backdoor IRA. If you already have an IRA, you can do a backdoor IRA. But it's basically a Roth investment account solely for the business. So I dump money in there like crazy. As long as I don't earn more than 11% interest on the money I put in there, it's zero. It's nothing. And that business has everything to gain from it. And then those funds transfer into business expenses, which those expenses get tax deducted off personal. And if you guys can see where this is going, it fills up those pockets. And like I'm in the second lowest tax bracket, which is like 12%. So something to think about.
Nice.
Yeah.
Thank you for all that, Roger.
Yeah, appreciate it.
So one quick question I have for you, Nick. So if you had to dumb it down for a Marine like me, if you had to dumb it down as simple as possible, how would you describe the relationship between taxable income and then tax credits, deductions, depreciation, all that stuff? Like why should I care about all this?
Oh, okay. Do I have a slide on that? So let's go back to, sorry if I'm giving anybody whiplash. Deductions. Oh, nope. Types of income. Here we go. Okay. So your gross income, all right, is all the money you made. All right. Based on that, all right, you can, based on your expenses, okay, you can deduct money from how much you made. And that puts you in the tax bracket that we talked about earlier. All right. And that's your taxable income. Okay. So your gross income minus adjustments. All right. All these will create your taxable income. okay, that will determine which bracket you go into. All right. Which I'm looking for the bracket here. Sorry, there was, I think, 63 slides. Oh, no, I missed it. Okay, so yeah, here's the bracket. All right, so this is the actual bracket off irs.gov. All right, as you can see, so this is our taxable income here. All right, if we made $100,000, okay, that would put us right here. That means from that 95,000 up to the 100,000, all right, we're going to be taxed at 24%. All right, and then for that percentage of income from 44,000 to 95,000, we'll be taxed at 22%. All right, and then from that portion of money from 11,000 to 44,000, 12%, and so on. Okay, the idea is to minimize your taxable income through as many deductions as possible. Okay, that way we're only in these lower, all right, tax brackets. All right, so we're taxed at lower amounts. All right, we also spread that out. Okay, so imagine we had one entity, one person making $200,000, like what we talked about Mr. Untaxable earlier. Okay, that means he would go straight down this bracket, okay, all the way to 32%. All right, and for $182,000, or from the portion of money for $182,000 to $200,000, he would be taxed at 32%. And then between 95 and 182, 24%, and then 22% and 12%, and so on. Okay, versus if we spread that out over multiple entities, like if he has a business, two businesses, his wife, his kid, okay, now they're going to be up here, all right, in these lower tax brackets. And so he's taxed, it's the same amount of income, but he's taxed at a much lower rate. Okay, does that cover it, or is there still follow-up questions?
That's a good job. Thank you.
Okay.
The reason I wanted to ask that question is like for everyone in the audience, but also for everyone in the audience to pass on to people that when you're talking to people about this, because this isn't just beneficial to us, it's also beneficial to our future clients. And so when you're explaining to them, hey, like if you own this property and more properties down the road, if you start this process of becoming a real estate investor and starting businesses and all this stuff, it's not just a one-time buy this house, sell it, make some money, move on, be a normal person. This can completely change your entire life. And so it's important for people to understand that, because even just like a 1 year example, looking at this chart, if you're at that 24% tax rate and then you apply all these principles and you drop into the 12% tax rate, that's cutting your taxes in half. So going from about $25,000 to about $10,000. And so when you think about that, like people, when they hear that and just in passing and just briefly, like in a scenario like this, they're like, oh, that would be nice if I would do that, but whatever, I'll just give up $12,000 to the government. But you don't realize, like applying it to our shoes where we're working for commission checks and all the time, effort, energy, blood, sweat, tears we put into helping a client. Sometimes like one of my hardest transactions, just because of like the emotional aspect, mostly from the client, but one of the hardest transactions only made like $5,000. And it was like a month and a half, almost 2 months long transaction. And so just think about that and use that to motivate you. Am I really going to let two of those 2 month long experiences just, oh, whatever, government's going to take it anyway, so I don't care about taxes, they can just have what they want, and I'll just go on with life. So just like find things like that to motivate you, or if it's like family things that you can help out with your family by having that extra 10, 15, $20,000. And then and the last thing I was going to say was going back to what you said about don't put the cart before the horse. A lot of people, they just choose not to make more money to avoid having like, oh, this is complicated. Nick has talked for now an hour and a half about all these tax strategies. This is just, and he put so much work into understanding it. I'm just never going to be able to understand this. I'll just ignore it and I'll just make less money, so I don't have to worry about doing this. The right answer would be to either put the time in and effort into understanding all this, or to hire somebody that is an expert in this and then make more money and make a ton of money so you can save a bunch of money using these tax strategies. But yeah, thanks so much for all this information, Nick. Hope everybody took a few nuggets away and starts applying it, especially before the year's over.
Yeah, thank you. I learned a lot making these, and it's I feel like it's really good practice at presenting online. So hopefully they're getting better.
5 stars.
Oh,
All right,
appreciate it.
welcome. I mean, thank you for coming to the meeting, and I hope you have a wonderful week. I'll stick around for a few more minutes if anyone has any random questions related to SkillBridge in general. And yeah, have a wonderful week. Aloha.